So the S&P 500 has officially hit a bull market. I'm completely sold out of all my S&P 500 holdings. Have I made a huge mistake? In this video, I'm going to be showing you my trading tool to invest and also ISA account. So I'm going to be showing you my holdings and my strategy to maximize my gains to improve my overall wealth. So as you can see, my trading tool to invest account has a portfolio value of £4,836. And over the last month, my return is a measly £3.52. And I will be explaining why. So for the first time, I only have 67 pence in free funds. So basically I have invested all my money into something. So the first thing I'd like to show you is how many free shares that I've gotten. So currently I've received 25 free shares and that is a value of £458 and that is all in my portfolio. So thank you for all the people that have signed up. And as you can see, there's been several people who have signed up who have received free shares, but I haven't received them. And this is because I only receive a free share when the promotion is running, which is not very often. And in the total amount, I've only received 25 shares. So let's go through all my holdings individually. So I have 0.1 shares in Walt Disney and that is down by 12.76%. As you can see, over the past month, Walt Disney has not been doing too great. So that's a loss of £1.35 for me, which is not too bad. They currently do not pay a dividend yield. And as you can see from their income statement, the revenue has increased. Net income looks good as well. Balance sheets look okay, but I'm not sure what exactly is happening with Walt Disney, but I don't have too many shares in that, so that's not a big problem. Next, I have Vodafone and I have 35 shares in that, and that's down by a big 17%. So that's a loss of £5.71. Vodafone still paying a dividend, and right now it is very high at 10.48%. There's been talks of Vodafone actually merging with Three to become a super group, but I'm not sure exactly what's happening with Vodafone or why the share price is going so low. But as you can see from the income statement, their revenue has been quite steady and their income is also increasing. Balance sheets, liabilities looking quite high and the assets gradually decreasing since 2020. So maybe investors are looking at all this, maybe they're looking at the cash flow, looking at everything and deciding that Vodafone is currently not a great deal to buy into. Of course, since Vodafone's heyday many years ago, there's been other companies like EE which have actually gained market share, and Vodafone isn't the go-to consumer brand for mobile phones, SIM cards and all that kind of telecommunication stuff. So next I have the Vanguard FTSE Germany All Cap, and I have 0.8 shares in that, and that's down by 70 pence. So that's a 3.56% loss. They do pay a dividend yield, but it doesn't say here, but I don't have too many shares in that, so that's nothing to worry about. So my next holding is in the FTSE 250 and I have 128 shares, being my largest holding in my invest account. And this is the precipice of my strategy going forward. Instead of buying the GSPX for now, I thought the GSPX might be in a bear market rally because it's gone up so high. I think I'm kind of priced out for now. I don't want to buy it so high. I'm not saying that it's not going to keep increasing. I think it might keep increasing. I think I've kind of missed the train for now on the S&P 500, which is a mistake. And I always said that I'm willing to take the risks of, you know, trying to profit off the volatility. So I'm okay with that. But now the FTSE 250, I think there's an extreme amount of volatility in the FTSE 250, but I also think there's a lot more potential growth here. As you can see, the profile looks very similar to the S&P 500 and it was kind of moving in the same way as the S&P 500, but there is a lot more potential to actually gain here. If we look from the peak to now, we're looking at about a 20% drop. So if I buy now into the FTSE 250 and it does go back up, there's no guarantee that it will. That is a 20% gain over the S&P 500, which if you buy now and it goes back to the top, we're looking at a lot less than 20%, something around 13%. But anyway, since I bought it, it's down by £9.48. I bought it at £29.79 and I do think it's going to drop down a considerable amount, but I'm going to keep buying into it. It does have a dividend yield and the ex-dividend date is coming up next week, so I'm going to hold it. I have 128 shares in this and I have a considerable amount more in my ISA and also my free trade account, so I'm expecting a dividend of around £1,000. So that's not too bad of a gain there, so I am going to be keeping it for the ex-dividend date and maybe selling one or 2 days after that, and if it makes profit then I definitely probably will look into that. But going forward, I'm going to be looking more at the FTSE 250 because I think there will be potentially more growth there, especially with the UK economy being very, you know, no one knows where it's going to go. So I think there is potential either for a lot of volatility, which I am a huge fan of, or there to be lots of growth, which I'm a fan of too. So yeah, I'm willing to take the risk on whatever happens here, but I'm happy that I've bought into the FTSE 250. Although if I waited a few hours, I would have got a better deal because I bought it around here-ish and then it fell down to 54, but it's okay. Next, I have the smallest amount in Tesla, so that's 0.04 shares, and that is up by 92%. So over the past month, Tesla has roared and soared and really uplifted the S&P 500. Tesla and many other companies that kind of focus on software or AI have completely shot up. Not surprised here. 92% gain in my portfolio, giving me a return of £4.61. Tesla does not pay a dividend yield, and as you can see, their revenue is growing exponentially. Their liabilities aren't growing in line with the assets, which is really good. So they have enough assets to cover their liabilities. You can have a look at the cash flow right here. But yeah, I do not personally invest in companies that have too much heat on them, because I think there's too much bad volatility. Bad volatility is where, you know, in something like an S&P 500 ETF, volatility is good because we know overall it's very diversified. However, volatility in a single company like Tesla is extremely bad for an investor, because really what you can see is huge losses that last a long time, and that's not something that you want to actually get yourself into, because you don't know the long-term potential growth of that company. So next I have Starbucks, and that is down by 5%, so it's okay. Over the past month it's done a huge drop, not too sure why, and that is down by 97 pence in my portfolio. Next I have 29 shares in Rolls-Royce, and Rolls-Royce has not been doing too great over the past month. However, overall in my portfolio it is up by 16%, so that's a £6.20 gain. It does not currently pay a dividend yield, and if we look at its income statement, its revenue has been increasing. Balance sheets don't look that great because they have a huge amount of debt. Remember, debt isn't always that bad, but at a glance, debt does look very bad. And then you can have a look at their cash flow too. But yeah, Rolls-Royce, I'm not too sure where that's going to go, but I think I will hold on to Rolls-Royce because I do think that Rolls-Royce has potential in the future, especially because they're such a great manufacturer of passenger plane, you know, engines. So that, and also the consumer market, Rolls-Royce being a staple luxury good. So I don't know, personally, I think that Rolls-Royce right now is kind of undervalued. And if we see it maybe in the next 5 years, it might be hitting 2 digits, as in like £10 or more. And I do think it is worth holding, especially if I'm holding such a tiny amount anyway. Next I have 1.6 shares in PayPal, and PayPal over the past month has been doing quite good, I would say, but it has remained quite steady over the past month, and in my portfolio it is up by 2%. That's a £1.68 gain. Currently PayPal does not pay a dividend yield. However, you can see from their revenue has been increasing very nicely. Their net income has dropped, and as you can see from the balance sheets, they are taking on more debt as the years go by, but also the assets are increasing. So I think PayPal will be fine, especially because they're a financial company. They're going to have a higher liability to asset ratio because of course they operate with a lot of debt. So I'm not too worried about PayPal. We can see that PayPal was extremely highly valued during the pandemic time, and it's gone down to a fraction of that. So I think PayPal will be fine for the coming future. Next I have 2.3 shares in Orange, and Orange has not been doing too well at all in the past month, and that is down by 7% in my portfolio. And Orange does have a dividend yield of 6%, which is quite good. As you can see from their income statement, the revenue has stayed quite steady, and also they have quite a high amount of liabilities compared to the assets. But I think Orange will be another company that I'm going to be holding on to, so I'm not too worried about that either. So Nvidia had a huge run in the stock market in the previous month, as we talked about, and currently has fallen since its valuation of $1 trillion company. And you can see that investors are not too sure if, you know, the AI boom is here to last, in my opinion. But Nvidia is up by 162% in my portfolio. That's a £17.24 gain. Nvidia pays the smallest amounts of dividend I've ever seen, so that's 0.04%. But as you can see, their revenue has been increasing exponentially until 2022, and currently the revenue has dropped, but they have investments in the pipeline, and I think Nvidia is going to be one of those companies that is going to benefit from the initial craze of the AI revolution. But I think that just because a player is the first for, you know, any sort of AI thing doesn't make it the most profitable, because to come out first is a very big gamble. You know, that's why Apple never comes out first, because they make sure everything's done properly. But Nvidia is one of those companies kind of resting on their laurels, thinking that they're the best in AI, where someone can just undercut them. You know what, Apple could be the company that undercuts them. We've seen that since Apple has made their own chips in-house, their processing power has grown super exponentially compared to Intel. We never know, especially since the Apple Vision Pro release. Apple has shown us that they are a player of everything, and I think Nvidia's days might be numbered. I would definitely not buy Nvidia at this price. Definitely not. But you know, no one knows the future. Nvidia could go up. I don't know, maybe ask ChatGPT. Next I have 0.255 shares in Nike, and that is down in my portfolio by 1.5%. We can see over the past month Nike has taken a tumble, and I'm not exactly sure why that is, but they do pay a dividend yield of 1.28%. As you can see, they have increased their annual revenue. Even quarterly, they are increasing their revenue, and their balance sheet looks okay to me at a glance anyway. So yeah, Nike is fine. Nike's going to be here probably for as long as I live, so I think Nike will be okay. Next, I have 0.4 shares in National Grid, and that is up by 4%, which is nice to see. And over the past month, it has taken a tumble. That does pay a nice dividend yield of 5%. As you can see, their income has been growing exponentially. Quarterly, maybe they've dropped, but as you can see, annually they've grown exponentially, but their balance sheets also reflect the increased amount of liabilities they do have. Well, I'm going to be holding on to National Grid regardless, but I wouldn't be really investing into a company like this. So next, I have 0.18 shares in Mercedes-Benz, and you can see over the past month they have actually increased quite a bit, so that's quite nice. I don't believe they do pay a dividend, but yeah, it is up by 0.44%, so that's 5 pence gain in my account, so that's not too much at all. Lloyds Banking Group, since the whole Silicon Valley Bank thing, has not been doing too great. As you can see, past month it's dropped quite significantly. That pays a nice dividend yield of 5%, and as you can see, their income has been kind of all over the place over the past 2 years with a very high amount of liabilities. And like I said, financial companies, anything to do with money and banks, will have high liabilities anyway, but there's always that risk of the liabilities exceeding their assets and how they would deal with something like a bank run. So something like that is still yet to see how that will unfold. Next, I have Royal Mail, and that is down by 7%. So Royal Mail has not been doing too great. I guess they didn't deliver on their promises again. High dividend yield of 8%, so I think that might get cut soon because is very high and they're not really making too much profit. So as you can see, their income's dropped, revenues dropped as well. So yeah, I think they're not doing too great. If we quickly look at the balance sheet, the total amount of assets has also decreased significantly since 2020. It's 3 years on now. So yeah, I mean, everyone knows the Royal Mail is not doing great anyway. IAG is down by around 5% in my portfolio, so that's a 52 pence loss, not too bad. I do have 6.3 shares in that. No dividend yield, but as you can see, their income statement, their revenue has increased significantly, so has their income. From the balance sheet, you can see they're taking on significant amount of debt, but again, airline companies do take a lot of debt because of fuel prices also increasing. They do have to stock up on a lot of fuel prices. They have to buy stuff before that, then the ticket prices actually cover that. So I'm not exactly a business analyst, but looks okay to me. Next, I have H&M, and that's up by 16%, which is really good. So over the past month, it has actually dipped, but it's still in my portfolio, it's up by 16%, which is a 1.55% gain, and they do pay a dividend yield of 4.54%, so that's really good. Their revenue has increased and the income has decreased small amounts. From the balance sheets, you can see they're taking on slightly more debt. H&M is one of those companies that has been on steady decline. Many of these fashion companies, since the recession started, a lot of people are going to be paying less attention to fashion, especially someone like H&M, where the price is not that low and it's not that high either. It's not a luxury and it's a non-essential, so that might be one of the reasons why it's not been doing too great, but we'll see what happens with H&M in the future. Next, GSK, and I have 0.2 shares in that, and that is up by 3.78%, so that's a 15 pence gain in my portfolio, and that has a nice dividend yield of 5.47%. As you can see, their revenue has been increasing, so has their net income. From the balance sheet, you can see that the total assets has decreased and their total assets are less than last year's liabilities, and they have a very high amount of liabilities, so I'm not too sure what's going to happen with them. You can see that the share price is significantly lower than what it was during around pandemic times. Maybe they've invested a lot of money into drugs and stuff that haven't really paid off, but I think that's a very cyclical nature of a pharmaceutical company, so I think GSK will be fine in the long run. Next, I have Direct Line Insurance, or Direct Line, however you want to call it, and that's just been steadily declining. Luckily, I only have 2 shares, and that's down by 17%, so that's 69 pence decrease. Those of you who have sold Direct Line a few months ago probably have made the right decision. That has a dividend yield of 4.5%. As you can see, their income statement, their income is negative 40 million or something, so really bad compared to last year, and the balance sheets are not looking too great either. So yeah, not a company that I would recommend investing in, even though I don't recommend any company to invest in really. Lufthansa has been doing quite well, so over the past month it has decreased, but in my portfolio it is up by 1.6%, so that's a 38 pence gain. They don't pay a dividend yield, and as you can see, their income has increased since the pandemic. No surprises there, as aviation has kind of taken off. Balance sheets are looking, again, airline companies will have a lot of liabilities compared to their assets, so I don't think that's anything to cry about. But of course, since the pandemic, the share price is a whole lot less. So Carnival, exactly one share, and that is up by 30% in my portfolio, giving me a £2 gain. Over the past month, Carnival has increased quite a lot, so yeah, looking quite good. The income has reduced, but the revenue has increased. Maybe that's gone into investing, I'm not sure. But anyway, looking at the balance sheet, I don't know, it doesn't look too great, but what do I know about that anyway? So that is doing okay in my portfolio anyway. BP has not been doing too great over the past month, and the government has said that the windfall tax on these companies might be stopped if the wholesale prices continue to decrease. So they do pay a dividend yield of 4%, which is really nice. And as you can see, of course, the revenue has been growing exponentially. Balance sheet's looking okay, and cash flows here. But yeah, BP has, of course, since the pandemic, has increased hugely. So over the past month, it has kind of decreased because, you know, now that the wholesale prices of oil and gas has decreased, and now they're actually profiting less, even though they profited huge amounts during pandemic plus. So yeah, BP probably a good company to hold for the long term, but it's a very cyclical business. You know, we always see cycles up, down, because the price of oil and gas always changes due to external reasons. Next, I have BMW, and over the past month, it has been doing quite well, but then again, last month it dipped huge amounts. In my portfolio, that is up by 6%, so that's a 72 pence gain, and it has a very high dividend yield of 7.87%. As you can see from the income statement, the revenue has increased exponentially, so has the net income. Balance sheets are looking quite good, and then cash flow is here. So yeah, good company potentially to hold on to, although it is operating at pretty much all-time highs, so take that for what it is. Aston Martin, which is a stupid company in my opinion, 1.3 shares in that, but that is up by a huge 91% in my portfolio, and that's a return of £1.82. No dividend yield, and as you can see, the net income has completely just fallen, and the balance sheets are not looking that great either. Apple has seen, of course, a huge increase in the past month, especially because they have released the teaser for the Apple Motion Plus Pro, something like that. I think I said it correctly last time, but it's completely slipped my mind now. It's the VR/ augmented reality goggles that are being sold for $3,500, which is ridiculous. It's going to be £3,500 here. But anyway, Apple's up by 22% in my portfolio. That's £6.53 gain. They do pay a dividend yield, again very small, but bigger than Nvidia at 0.53%. As you can see, the revenue has been increasing. I wouldn't worry about Apple's balance sheet either. They have so much cash. Apple will be fine probably for the next decade or so, if not more. Amazon, I have 0.9 shares in Amazon, and that is up by a big 30%. So over the last month, it has increased quite a bit. You can see here, this is where kind of like the whole AI revolution thing peaked and then kind of went down. But the S&P 500 has since still increased, so that is good. That is up by 30.5%, like I said, £21 gain. Amazon does not pay dividend. As you can see from the annual income statement, the revenue has increased and the balance sheets look fine too. Next, we have Alphabet, and I have 0.1 shares in that, and that's up by a big 30%. So you can see the same kind of profile, peaked at around 6th of June and then kind of decreased. Investors aren't really that confident in the whole AI boom. Not saying that AI boom won't happen, but maybe it won't happen now. But it's up by 30% in my portfolio, so that's a £3.27 gain. No dividend yield, but as you can see, income statement, balance sheets, all these top companies will have great balance sheets and income statements, so there's kind of no point of looking at it. And last but not least, AMD. That is up by a huge 59%, so that's a £1.19 gain. And over the past month, it has been doing very well. No dividend, but as you can see, again, income statement, balance sheet looking really good. AMD is one of those companies that has so much potential future because they have their fingers in many different pies. They have their fingers in kind of like this consumer side, so with their graphics cards, with their processors, but also the industry side such as servers and stuff like that. And then also they're potentially working on AI with their GPUs having AI cores in the future, and of course they're working on games consoles and stuff like that. So I think AMD is going to be very good in the future. So if I quickly want to check my interest on cash, because I'm not holding a lot of cash, I'm not getting a lot of interest right now, but I was holding quite a bit of cash until the 7th of June, so I've got 14 pence, 13 pence. So currently I have received 41 pence in interest, so that's nice. So now I want to show you my trading 212 ISA, and as you can see, currently my account value is £20,848, and as you can see, my free funds are £921, and this will correspond to how much profit I've made in this account already. So I'm very happy already with the amount of profit I've had. if you go into my history, you can see that the realized profit is £918 and the rest will be made from the interest. So I've already received £2.91 interest, which is really nice. So using my strategy of trying to kind of time the GSPX, it has kind of paid off. I have £921 in free funds. So that already represents a 4.6% gain in this financial year, which has not even been 3 months yet. So I'm very happy with that. My aim is to get 10% a year for 10 years. So I do think I can get that even during times of hardship, which I've proven over the past 2 years. It has been times of hardship and I've gotten over 10% a year. But like I said, the GSPX, I think I'm timed out of the GSPX and now I think I will buy the FTSE 250. So I have 670 shares of the FTSE 250 and since I bought it, it's down by 0.36%, so that's okay, but that's a loss of £72. That's why my portfolio is down a bit. I do have a sell order at 29.87. I'm actually going to cancel that because I don't want to sell it before the ex-dividend date, which is next week. I'm going to hold it until the ex-dividend date and I think I will receive something around £1,000. Maybe my math is not correct, but it'll be something around 400 to £1,000, which is a nice amount of dividend. Then I will choose where I want to invest that money, but having a nice dividend is quite nice, especially within an ISA. So yeah, going forward, I'm just going to be buying the FTSE 250. I do like how much volatility this has and also the potential growth going forward of the FTSE 250 compared to something like the FTSE 100. I think the FTSE 250 is undervalued. It is also quite well diversified, so I'm not too worried about losing money on that. But make sure to check out some of my other videos and I will see you in the next video.